Hi, this is Roger Nussbaum. Thanks for tuning in. This is the big picture for the week of September 24th, 2006. Before I get started, I noticed that Adam Warner over at the Daily Options Report also tried this video blogging thing. Looks pretty cool. I'm going to keep going. I had one person say it's not a good idea. I don't think 2 attempts is enough to rule it a success or a failure, so I'm just going to keep going for now. This week we had a zillion ETFs get listed on the exchange, and that I've been doing quite a bit of writing about that, and I'll do some more. But for this weekend's column, or video post, I wanted to talk about an email I received from, I mentioned him last week, reader Tom K. He asks, do you have a list of asset classes and the percentages you think best represent equal weight for each? This was in response to a comment I made in a post about 7% being equal weight for emerging markets, in my opinion. That 7% is my own number. I did a post on it a while back where I came up with that. Basically, in picking apart a particular global benchmark, I came up with 7%. He asks, he realizes everybody's different. If I were forced to prescribe the same allocation for everybody, what would it be? Well, I'm going to pass on answering it in that way. I don't think that's constructive for anybody. If I say 20% in one thing, that either is exactly right for you or it's dead wrong. Chances are it's dead wrong. I think maybe I'll take a kind of a bigger picture view of it, which is to say that it's important to have exposure to every part of the market, in my opinion. 15 years ago, maybe that was just stocks, bonds, cash. That's all anyone really thought about it. Now, in the last few years, people have added, maybe 10 years ago, started to add real estate investment trust to the mix. What's an appropriate recommendation there? Tough to say. About 5 or 6 years ago, there were no REITs in the S&P 500. And lately, they've started to add some. It's still a very small exposure, so small that it practically doesn't even exist. But nonetheless, it's in there in a little bit of presence. Another one that's come to the front lately, obviously, has been commodities. Some people probably owned too much as that bubble, or which is not a bubble, as that part of the market lifted and inflated. There was certainly a mania around it, even if there wasn't a bubble. And now people may be feeling some pain if they own too much, but a little bit of exposure, which is what I've been preaching all along, is far from a death blow to a portfolio. Lately, in the last few months, I've been talking a lot about having cash as a foreign cash as an asset class. This is an important thing to me. I get some, as you would expect because it's new, some dissenting comments. I think there is a place for it. So from there, let's think about commodities. In my opinion, 5% probably makes sense. I disclosed at one point during the week that most clients have exposure to the GLD ETF, and some people have a mining stock as well. That's about it. I've never really had more than that, to be sure. You've probably read the same articles I have talking about 15% or 10% or some very big number. Well, that's great on the way up, but these last few weeks or however long it's been will tell you that that's not such a great way to go. And I've never thought that even 10% was a number that I wanted to expose client money to. It's just too much. Real estate investment trust, everybody has at least one at about a 3% weighting, and it's probably a little bit more than that now because it's done pretty well. I've got a couple of people that are a little sensitive to volatility, and so they have 2 REITs, and so maybe their exposure is up around 6% or so. To tell you the truth, I haven't thought about that as really being equal weight or underweight. I think of that as a tool to reduce volatility and add yield first and foremost. I've written quite a few times about the Macquarie Infrastructure, MIC. Most clients own that. I own that personally. I view that as very similar in terms of what I want it to do as a REIT. Reduce volatility, provide some yield. It clearly does not, it's not a real estate play in my opinion, but it has a lot of the characteristics. So there we're kind of capturing effect, even though it is different. Hopefully that makes sense in the way that I'm saying it. As far as stocks versus bonds, there's a mathematical argument that you should own no bonds. and it makes sense. It's probably correct. Not that I do that. That's, bonds, again, are a tool that at times should be heavier in a portfolio than at other times. Probably right now, not so heavy. Rates are, very, very low by any historical standard. More equities, the better in general terms. Now, there are some things that I think of as being in the middle. The covered call closed-end funds. Is that an equity product? Is that a fixed income product? You can decide for yourself. I've kind of written, when I wrote about these a little more frequently, that I view them more as a fixed income product. They tend to be less interest rate sensitive than a bond fund, for example, but they do take some equity market risk. It's just a whole lot less volatile than just buying an S&P 500 fund or a common stock or whatever. But so all of these things add up, and I absolutely believe in these call writing funds, but clients only have one. It's maybe 2 or 3, maybe 4% of a portfolio, and that's it. If the whole concept goes poof right before my eyes, well, that's too bad, creates a lag, no real ruinous damage, as opposed to being 10% in the whole genre going poof. These were done a little differently 20, 25 years ago, and they kind of did go poof. So fair warning not to get too heavy into, as an example, it's a great idea, but I'm not that heavy in it, and it shouldn't be too heavy in anything. The currency thing, I'm pretty small in that. Most clients have one currency ETF. I've disclosed it before, but the name isn't even important. It's just my opinion that there's some value to be added. There's visibility for a weaker dollar, and it's just a small little hedge if that turns out to be correct. This is kind of how I operate as far as trying to spread out risk. Usually, most of these things tend to do well. Occasionally, when there's something really bad going on in the market, a couple of these things will shine. If we have some sort of terror event, gold is going to do well, clearly. Perhaps by some extension, the rest of the commodities that are exposed, both either directly or indirectly, like an Australian bank as an indirect example, should do better in that sort of situation. Not much better, just a little better. And that's kind of the thing, is just spreading around the risk. And hopefully when there's crisis, all of these things do react a little differently. But more often than not, I doubt that it's going to offer a whole lot of effect. Hopefully this helps a little bit, Tom, with your question. That the way it was worded, I was just not going to answer it directly. That's can of worms that's just not good for anybody. But I hope you have a good weekend, and we'll talk to you later.